All right. Good evening to all the participants. This webinar that we are conducting, which is it's being led by AAAG and Company LLP Chartered Accountants. Earlier, this CF firm was known as AKG and Company, and it is in the last 1 year we have actually changed the name of this company from AKG and Company to AAAG and Company LLP. This CA firm is also expanding a lot. Ankit Goel is the designated partner, and he is having the overall responsibility of CA firm. Mr. Sandeep Vij is a very intelligent brain that is available to AAAG now. So the AAAG has all these synergies with AAA Group. This is 36 years old CA firm and presently engaged in all kinds of activities which a CA firm does, including forensic audit, including the ASM, restructuring, debt syndication, mergers and acquisition transactions, all kinds of compliances. And I think presently this CA firm is dealing with almost 300 families, looking after all their requirements as a chartered accountant. So welcome to the panelist, and also I'm definitely grateful that this CA firm is also coming up with the webinars of this kind. The timing of this webinar, this subject is very important in case we see that in the past few months, a lot of notifications have come. The government is actually trying to be more, trying to ask the entrepreneurs to be more transparent, responsible, and up to date. So that is the kind of objective that we feel that the present government is insisting on. If you would see that there are a lot of changes which are proposed, maybe with effect from 1st April 2022, like the financial statements that we would be making for financial year 21-22. All these changes are applicable to the financial statements for financial year 21-22. However, this is also important that we should understand all these impacts today, because we all are preparing for financial statements for financial year 2021. And while we are making the financial statements this year, we have to keep these changes in mind. Otherwise, next year, we might have to recast various parts of the financial statements to make it matching. There have been changes in the Schedule 3 of the Companies Act, audit report, director's report, and there are a lot of changes in the format of Form 26AS, which is available at the income tax website for each party. GST related reconciliations are also very important. See, while we see this the amendment in the Companies Act, all those amendments, although not notified so far, but see, like you probably would see that the government is having intent that most of the compliances should be kind of penalty based, and the penalties are also being reduced. The prosecutions are also being shifted to penalty regime. So the intent seems to be like for smaller companies, there are relaxations, and for larger companies, there are more tighter regulations. I would say that, see, like in this webinar today, we would be covering the company's audit and auditors rules, which was notified on 24th of March. We also would be covering the company's account rules, which was also notified on the same date. Caro modifications that was also notified on 25th of February, of course, 2020, but later on it was also further modified in December 2020. So a lot of ratios has been added into the financial statements. Important to understand the definitions of ratios so that the financial statements made for financial year 2021 are also made accordingly to have it comparable financial statements in the next year. The default reporting, because whatever experiences the government or the based on the feedbacks, there are a lot of defaults that people are not reporting. There are lot many balance sheet that we have seen under insolvency where the assets are not even owned by the company, the title deeds are not even owned in the name of the company, but still the assets are shown in the balance sheet without any kind of qualification. We have also seen that various very important brands are not in the name of the company, whereas the most of the expenditures for promotion of the brands are spent by the company and it is being claimed as an expenditure of the company. So all this is important to start preparing now at this moment so that for the entire year an understanding is developed, the human resources are trained, so that when we prepare the financial statements for the next financial year 2022, 21-22, at that time everything is completely prepared. So Ankit, you please take up this part of recent modifications, and I have seen the PowerPoint presentation that you have made. It is wonderfully made. It's a complete knowledge, and the no beating around the bush. It is complete knowledge for the benefit of professionals, entrepreneurs, directors, people who are working in the companies at different level. This is very important. Sandeep Vij also would be taking a couple of parts. I would be today playing a role of uh, audience and would keep asking you the questions wherever I feel that it requires more clarification. I would keep asking you the questions. Over to you, Ankit. Thank you.
Much. Thank you. Good evening, everyone. Good to see a good number of participants today with us. So without wasting more time, I'm sharing my screen. So the focus is to look at what needs to be done for the financial year 2021, for closing financial year 2021, such that we are most secure, such that we are least troubled with the upcoming regulatory changes in 21-22, along with understanding what are the changes in 21-22 and how we will have to our approach, the approach of a business in maintaining accounts, doing the filings, so that they're also compliant with the regulations, or whenever they are supposed to file financial statements next year, they're also compliant with that idea. But we will focus on those things that we think we need to take care of in financial year 2021 itself. One of the most important things that everyone should understand is that when financial year 21-22 financial statements will be made, financial year 2021 financial statements will also require to be stated in the form of previous year figures. And when these previous year figures are stated, at that point in time, the auditor will also be accountable perhaps for all the ratios, all the other disclosures that are required for previous year figures. Therefore, all auditors, all fellow professionals will also in most probability look at all those compliances, how those disclosures in financial statements for financial year 2021 will affect their audit role or their professional role for financial year 21-22. So I will move on to my slide. So these are the contents that we also publicized on our banner, that we will talk about Schedule 3 audit report and director's report. We will talk about what information is now available in Form 26AS. How does it help? What reconciliations need to happen, or what all needs to be done to reconcile 26AS? We will look at ITR, we will look at GST related reconciliations, we will look at ITR filing, things that you should remember while doing that, practical tips for early closing of financial statements, and we'll also look at important timelines for financial year 2021 that are coming up, based on which we should try and close our financials sooner. So coming straight to Schedule 3 and Caro under Companies Act. So we would like to say that the applicability the applicability of Schedule 3 is on all companies, irrespective of whether they're small companies, etc., etc. Small companies, however, recently the government also changed the definition of small companies with effect from 1st April 2021. But the definition of small companies for financial year 2021 remains that the share capital should be up to 50 lakhs and the turnover should not be more than 2 crores. Next year onwards, 21-22, those businesses which have a paid up capital of up to 2 crore rupees and which have turnover of up to 20 crores, that is 20 crores of turnover in financial year 2021, will allow you to claim the exemptions of a small company in financial year 21-22. So, what are the exemptions? Caro becomes exempted for small companies. Cash flow statement becomes exempted. Board meetings, there is a relief that you can do only 2 meetings and do away with that. Auditor rotation becomes exempted. There is a simpler annual return for small companies wherein directors, KMPs, remuneration, list of directors is not required to be disclosed. And again, KMP and key managerial personnel and managerial remuneration limits are not applicable to small companies. So, Schedule 3 was amended by notification dated 24th March. We also had companies auditor rules amended by notification dated 24th March 21. We also had some changes in the director's report. We also had Caro changes. Caro changes were originally thought of to be implemented with effect from financial year 2021, but they were deferred due to the COVID pandemic to 21-22. So they will also be applicable next year. So all these changes, there are a lot of synergies in these changes. Some changes are made in such a manner that a change in financial statement is also a change in the Caro report. So all these changes are kind of merging together into creating better usable financial statements for the general public or for the users of financial statements. So these changes that we will talk about are applicable for financial year 21-22, but we will talk about how they affect 2021 as discussed already. So the first change that affects perhaps the previous year figures is the disclosure on the promoter shareholding. So far, Schedule 3 talked about shareholding of names of shareholders and their shareholding wherever the shareholders held shares more than 10% of the company, 5% of the company. Directors, wherever they held shares, they were also required to disclose their shareholding. But now there is a change that even promoters need to disclose their shareholding, and they will also require to disclose their previous year shareholding. What is the definition of promoters in the Companies Act? Promoters under 269 of the Companies Act can be anyone. He can be somebody who is recognized in the prospectus as or in the annual return as a promoter, who has control over the affairs of the company directly or indirectly, whether as a shareholder, director, or otherwise. There is a possibility that somebody is a promoter if he's part of day-to-day operations or taking care of the company or taking having control over the affairs of the company without being a shareholder or a director. And a promoter who is he can also be somebody without whose advice or without whose directions the board of directors does not function or is accustomed to act with the advice of that person. So promoter holding is therefore important. So wherever there were promoters who were not directors or shareholders, they will need to understand that they need their shareholding in the company is also now required to be disclosed in the balance sheet. So this is something that will appear in previous year figures. So in case somebody says that I don't want to have the promoter tag in financial year 21-22, then the time to plan for that may be right now. Then the next important disclosure is with respect to the aging of trade payables. So aging of trade payables, there was no requirement earlier that trade payables aging needs to be disclosed, but this has ramifications in various laws. and I will discuss all those ramifications. But this is the schedule that MCA has designed for the business owners, for company owners, or for companies rather, to report in the financial statements for the next year. And along with the next year financial statements, one will also need to disclose the same period, same aging chart for the previous year when they disclose the financial statements next year. So if you observe, the first of all, there is a classification that the classification is between four different columns. That is outstanding, where trade payables are outstanding for less than 1 year, outstanding between 1 to 2 years, 2 to 3 years, and then more than 3 years, and then the total number. Then on the column side, you will find that there's a diversification. There's a breakup. The breakup is that it can be undisputed MSME outstanding. It can be an undisputed other outstanding. It can be a disputed dues outstanding to MSME, disputed dues outstanding to others. This aging needs to be computed based on the due dates of payment wherever they are agreed. So how will we know that what is the due date of payment which is agreed? The due date of payment can be agreed where the due date is written on the invoice. Due date can be written on the purchase order that you have sent to the person who has supplied you goods or services. The due date can also be part of an email which might have been received or exchanged with the supplier. So that is from where due date can be received. If there is no due date, then the date of transaction will be the date on which we will assume that the amount is payable immediately. Unbilled dues shall be disclosed separately. So unbilled dues is something where the bill has not been received, but you are saying that, okay, I have this expense that I will have to make, so you provide for it. So what will change because of trade payable aging schedule? What will change is that bill-wise settlement of payments and accounts will now become more important. GST input reversal for payments outstanding for more than 180 days from the date of invoice will also be very, very clear. Now that you have to give this schedule, you cannot hide those payments that are outstanding for more than 180 days. Although GST says that those payments which have been outstanding for more than 180 days from the date of transaction is what you need to reverse, or the date of invoice is what you need to reverse. And the schedule talks about the number of days from the due date. But still, it is trackable that in case a trade payable is due for more than 1 year from the date of outstanding, from the date it was repayable or payable, the GST reversal also should be done on that. So based on your financial statements which are available next year, GST department can come back to you and say that please verify that you have reversed GST input on these payments that you have booked, which you have shown in your financial statements as outstanding for more than 1 year. Period of default on payment of MSME. So all of you might be aware that MSME Act says that wherever you have not been able to pay the amount outstanding within 45 days from the date of invoice, that's where the trouble comes, that the default amounts to some interest being levied on you, and that interest is a very, very heavy interest. So MSMEs are again differentiated in the trade payable schedule, and they are also distinguished between disputed and undisputed payables. So that is now even more clear that this compliance that is in the financial statements, whatever you will report, also needs to match with what you are reporting in form MSME 1, which is required to be filed by all companies by 30th April 2021. Auditors will need evidence of dispute in case of disputed creditors. So in case you say, no, I don't have this creditor is disputed and I want to classify it as disputed creditor. But the auditor, to sign the financial statement and confirm that these are disputed creditors indeed, will need an evidence. So you need to prepare that evidence or make sure that you have that evidence. Admitted disputed creditors and undisputed creditors may use disclosure for pending prospective litigations. In case you say that, no, you recognize that pendency, and you say that, no, this is undisputed. In that case, somebody can say there is a recent Supreme Court ruling that has further clarified that in case a balance sheet confirms that there is an outstanding liability to somebody, then that is again a confirmation of extension of limitation, that that limitation period then goes forward based on that. Income tax authorities may use this disclosure to say that you have not paid this amount to this person for the last 2 years, 3 years. Please make sure, please check. We want to check whether these payables are genuine, these payables are genuinely payable by you, or please give us the confirmations that the other party also has these payables from you. So all that will also have a practical implication.
That means, Ankit, in case this, like in case we stay on this sheet, this the information about disputed creditors is a very, very important change. The practical, you have touched various issues. We have also seen a very, very recent Supreme Court judgment that if balance sheet acknowledges a debt, then there is no applicability of Section 18 of Limitation Act. But uh, there is a there's something it is mentioned, like in case this uh, is mentioned in the balance sheet that these are not payable because of the limitation, then Section 41 uh, subsection 2 of the Income Tax Act would be applicable, which is remission and recession of the liabilities, and it would be taxable. So this actually would become a lot more important for all the entrepreneurs, that the the management of creditor should be properly done. Documentation should be properly done, and in case there is a dispute, that dispute should also be recorded in the financial statements. This part is actually important, having an impact on the insolvency limitation law, the income tax. The income tax department will come to know that these are the creditors which are outstanding for the last 2 or 3 years or even more than 6 months. They can ask why the amount is not being paid, in case really these amounts are payable or not. In case not payable, then you pay tax on this. Yes, this is an important. Please go ahead, Ankit.
So the similar thing, or rather, the same kind of a format has been adopted for trade receivables. Here, there is a difference that the differentiation has also been made between less than 6 months and 6 months to 1 year. That's primarily because less than 6 months outstanding trade receivables is an important number that was also captured in the previous schedule. And this is also an important number for banks and other agencies which give finance based on trade receivables. But giving disclosure of 6 months to 1 year, 1 to 2 years, and 2 to 3 years, and beyond 3 years will also help everyone understand the quality of trade receivables. So before this kind of a detailed aging analysis was given in the financial statements, it was frequently understood that whenever detail is asked for, at that point only the detail will be understood. Otherwise everyone will believe that okay, there are maybe some trade receivables which are outstanding for more than 6 months, and that's something that we will always say that okay, these are recoverable. But the point is that as soon as you're saying that no, I will have to now disclose that these trade receivables are rather pending for more than 3 years, I will have to have very, very strong evidence to say that these are recoverable, or these are undisputed, or that they are not considered doubtful. Because I will have to have very serious evidence to say that no, this money will come in. In case something has not come in for the past 3 years since it was due, then the probability of that coming in is anyway scarce. But now with this kind of a disclosure, it will become difficult for companies to avoid impairment, or rather write off or bad debt provisions in their balance sheets in case the trade receivables are not receivable. So they will have to put that. Auditors, in my opinion, will also look at this schedule for financial year 2021, because they don't want to be caught in a situation where they are having to report all the trade receivables that were outstanding as on 31st March 2021 for more than 1 year, for more than 2 years, whatever they classify as trade receivables which are not considered good or considered doubtful in the next year, whereas in the very year before it, they were classifying it as considered good, or considering it as undisputed. So this is also important. Aging again is important. Unbilled dues are also required now to be disclosed separately. There are a lot of companies which were not disclosing unbilled dues separately. Unbilled dues are dues where you have not raised the invoice, you have maybe done some work, and you are saying that, okay, I've not raised the bill, but I've done the work, and these are dues receivable from the company, even if I have not billed them. So this is something, the disclosure of unbilled dues and trade receivables will be something which will really help in understanding the quality of trade receivables for users of financial statements.
But this
Um,
concept of uh, unbilled revenue, this was actually being used by many corporates for window dressing of the financial statements. This particular item was used because the no GST is applicable on this, no TDS is applicable on this. Somebody simply can say that this is what we have assessed, that this is the work we have already done on various orders that we have in hand, and this much is the amount which is unbilled, where we have already incurred cost. So this figure, normally it should have been appearing in the inventory, but just to artificially increase revenues, some companies were resorting to this method of booking as unbilled revenue in the total income of the company. So this also gets checked with this amendment. Also, this country, most of the working capital is being availed by companies uh, as against hypothecation of stock, hypothecation of book debts, bill discounting. So the hypothecation of book debts is at times is being misused by some companies. They keep giving a statement that every debtor is within the 3 months or 4 months, whatever is the retention period approved by the bank. They would always declare in their statement that all the receivables are within the stipulated retention period time. Whereas now, of course, from now onwards, whenever this kind of statements would be filed, that would be very easy for the bankers to compare with the financial statements which are audited, and the auditor have already classified these debtors into four different categories. So this actually is a most welcome amendment, and it would actually avert many misuse, uh, avert many kind of frauds in the banking segment. Over to Ankit.
It will also encourage, so adding to that, it will also encourage companies to go for some kind of litigation, some kind of a proof that they're actually recovering or trying to recover the trade receivables. In many companies, we see that there is no action on something that is not coming, and yet the company says we are following up, we are following up, we are following up. So, because the companies and the auditors will need substantive proof to say that these are undisputed and these are considered good, companies will also be inclined to act legally quicker so that the dispute is not raised before the litigation starts and the dispute actually takes. So this will also be something where, of course, OC's limit is still 1 crore rupees of debt. But other than that, also there are other ways to claim recovery of debtors. And that's something that I feel that companies will now be more inclined to do, especially with this kind of a problem in the financial statements also and for the auditors also.
See, whenever the auditor will seek documentation for the creditors, will seek documentations for the debtors. This actually will be advantageous to the companies, to the entrepreneurs. When the analysis of the creditors are being done by the auditors, the matter will come under view of the uh, management also. Management also should prepare at that time that there are possibilities. The auditors can also guide in case the auditor has some information about insolvency law. They can also guide that there is a possibility of insolvency attacks on your company, because there are so many creditors which are more than 1 crore, and there is a default. The company has not been able to pay, and the company should be ready to or should actually prepare itself for any insolvency attack. Now, insolvency attack is that once a notice comes to you, after that, it will be very difficult to raise a dispute regarding quality, delivery, price, or even the order was not placed or placed. All these kind of disputes can be raised only when this when notice under section 9 and section 8 and 9 is not received by the company. Now let us understand that the companies are not prepared, and uh, the notices are received and the company has no option except to go for the insolvency or make payment. Otherwise, in case the companies are well prepared, then they can even record all kinds of disputes, may it be quality dispute, price dispute, delivery dispute, damages, whatever it is, they can record the disputes by way of sending mails to the suppliers. That will protect them from any insolvency attacks. On the other hand, when the auditor is analyzing the debtors, the management actually can be alerted on various receivables which are beyond the due dates, and the auditor can also discuss the remedies which can be taken by the uh, companies for recovery of that amount. Insolvency is a very big tool, and we have seen that more than 70% of the cases, the money is recovered without even filing an application. And, and when we see the total application filed, 70% of the applications which are filed are either withdrawn or settled within the court. So that means in case we see overall the most uh, biggest advantage that has actually been received by IBC is by the operational creditors, because they have been able to receive their money by just giving notices. And in case there is any intent of the customer not to pay you, then the customer will immediately inform you regarding any dispute, so that you prepare and you stop supplying to that customer at least. See, so far what was happening in the past is that the companies were able to sit continuously. The debt used to be kind of gathering, collecting huge amounts. So the information was, the intent of the customer was not known. Now the intent of the customers would be known. Either they would report the dispute or they will make the payment. So this would be really, really beneficial change in the financial statements. Over to Ankit.
So these are the next step is also very important. So there is this requirement to report the financial ratios or these financial ratios in the financial statements. I will discuss these financial ratios quickly. The idea is that when we will report these financial ratios for financial year 21-22, we will also need to report the financial ratios retrospectively for the previous financial year. So what we are advising is that we should rather have the financial ratios for financial year 2021 ready with us for this year, so that in case there is any I don't think a financial ratio can be modified, but if the basic amount or the basis on which the financial ratios are being computed, they can be modified, corrected, they can be clarified, they can be disclosed separately in the financial statement, then that is something that one can do. All that is something that is possible. So what is the implication of the ratio? So at present, the stakeholders such as bankers, investors, they used to compute these ratios to analyze the financial strength of the company. Now the company has to disclose these ratios in the financial statements itself. So what it does is that every company has to show these as previous year numbers, and the company is also required to explain the items included in the numerator and denominator for computing the above ratios, and an explanation shall also be provided for any change that happens beyond 25% as compared to the preceding year. So this is the kind of reporting that is expected now. So current ratio, I believe all of you understand current ratio. The impact of current ratio being part of the financial statements gives huge information to all the people who are looking at maybe even the unsecured creditors or people who are going to sell goods or services on credit to the organization. In case they see that the company is having a negative working capital or the company is having a working capital wherein bigger assets are lower and there is so the current ratio, which is less than the usual 1.3, might raise some eyebrows for a lot of people. So that current ratio should be maintained. If not maintained in financial 2021, then definitely the company should maintain it at 21-22. Debt equity ratio, again a ratio which is very very important for the to understand the financial health of the company, to understand what is the debt, what is the equity, how much equity is available to if there is a default. That is what is debt equity ratio, very very important ratio. Debt service coverage ratio will talk about what is going to be the total repayments that are planned for the next year, what is going to be the total PAT and depreciation interest charges that are going to that are available for the company in that year, and then how what is the percentage of all the available money for the purpose of repayment of debt, whether that's principal or interest. Return on equity ratio, again, a very, very important ratio where you talk about the
So,
performance of the company.
Ankit,
Yeah.
Ankit, on this debt service coverage ratio,
Hmm.
the we need to understand whether there is a clear definition given in the Companies
No,
Act, like it has to be calculated like this.
no, there's no definition. These are derivative, these are our
So
understanding of these
there are two
ratios.
ways of calculating DSCR.
Hmm.
One is that where we actually uh, divide the uh, cash accruals after interest payment,
Hmm.
and divide it by the debt which is payable within 1 year. So that is kind of considered to be the only on the repayment obligation. So debt coverage ratio can be calculated on the repayment of loan only, and also the interest and the uh, repayment both, because the ratio would change significantly if we add interest in the both the parts, the uh, in the denominator as well as the other part. So the two ways of calculating is, it depends like what is the importance, what is the purpose of this DSCR. But then I think this should be explained in the Companies Act, whether it will be taken with interest or without interest.
My expectation is that the clarification should be given by the institute on how these ratios will be computed. And in absence of a clarification, the idea is that a company may adopt either of the two ratios. All it needs to do is justify or tell on how they have used, what is the numerator and the denominator that they have used in calculating these ratios. So in case net or gross DSCR, which of the two needs to be computed, one company can compute one and the other can compute the other, as far as it is not clarified or communicated by the government. So they have not said anything beyond debt service coverage ratio, not a thing.
But I would certainly say that the choice of ratios are very important for working capital management.
Yeah.
If you will just take one slide back, I would like to say that these are the specific ratios which are actually important for the working capital management, like this inventory turnover, trade receivable turnover, trade payable turnover. These are genuinely only and only for working capital management. uh, we see probably there are a lot of chartered accountants, bankers, they are associated in this particular webinar today. They might have seen that if the inventory turnover ratio is like increasing, that actually is a very, very big indicator of stress in the company. Similarly, if the trade receivables ratio is increasing or trade payable turnover ratio is increasing, that also is a indicator of financial stress in the company. So the ratios are actually selected very, very carefully. Yes, Ankit, over to you.
So return on equity ratio, again, a very, very important performance ratio on what is the company making for the equity shareholders. Inventory turnover ratio, as Sir just indicated, that it is a very, very important performance ratio on how many times is the company able to turn around the inventory. Some industries can have a standard of 2 times in a year. Some industry can have a standard of 12 times in a year. Some industry maybe have 100 times. So it will totally depend on, it will also measure what is the working capital management level of the company with respect to inventories. Trade receivables turnover ratio, very similar. You understand the net credit sales and then use the average accounts receivable to compute this ratio. Again, a very important ratio to understand what kind of credit is expected by the market from the company, and that's something that is important. Trade payable turnover ratio, again, total purchases divided by average accounts payable, what kind of credit period is available to the company from its from its creditors. A very high trade payable ratio, somebody might say, is a very good thing, but in my opinion, it will also talk about how a very high trade payable ratio might also talk about high interest or high interest cost that is being collected by or that is being paid by the company towards trade payables, especially in case of typical industries like iron and steel industry. A high trade payable ratio may not be a good thing or may not be an advantage in terms of profitability. Net capital turnover ratio is what is the money introduced by the company, by the shareholders in the company, what is the net capital that is invested in the company, and what is the turnover that they are making. So
Ankit, we need to be a little careful because I think the internet is not stable, and in between we are getting freezed as our video is concerned. So that is the reason that I am going off video whenever you are speaking. And even there is a feedback that you should speak little loudly, and the voice is not
I will
purely
speak louder.
audible.
I will
Yeah.
speak louder. I will speak louder. So net profit ratio, again, a very standard ratio. Net profit divided by net sales talks a lot about what the money company ultimate ratio. People say that this is the ultimate ratio. If the company is not making enough money on the sales that it is making, then what it is it working for? So return on capital employed. I'm jumping on these ratios because I also am managing my time. So I think all of you understand the importance of these ratios. I have briefly tried to talk about what these entail. Return on capital employed is again something where one talks about the total capital employed, including debt, including deferred tax liabilities, and all that, and then says that okay, how much money is the company making before interest payments? So even if the company says that okay, my net profit is negative, maybe a return on capital employed will still be positive. So that's something that can be computed at times. Return on investment is again something where one simply says that okay, what is the extra money that you have made based on your what was the cost of investment, what is the current value of investment, and what is the money that you have made. Coming to the next part, capital work in progress and intangible assets under development. So these two parts, capital work in progress and intangible assets under development, was a dead end for many companies, where one figure being put into the financial statements had no explanation whatsoever. There was no disclosure in most financial statements on how long is the CWIP or how long is the intangible asset under development outstanding for, when will it be capitalized, is there a delay in the capitalization or the project that was being undertaken. So that is now clear that you now have to give an aging of the CWIP as well as the intangible assets under development, and that now becomes important because when you have that, then you talk about then you also have to talk about then you become the company becomes more liable, or I should say the company becomes more accountable. Then the company is also required to talk about the delay or projects which are suspended and projects which are delayed. And for those projects, the company is required to talk about the project-wise estimate of when will it be completed, and uh, uh, will they be completed in 2 to 3 years, 1 to 2 years. So the company's expectation on when projects will be completed is also required to be disclosed. Relationship with struck off companies, and we all know that some companies were struck off, companies which were reported as companies which were not filing their returns, companies which were reporting that were located by the government as entry companies and so on. So in case a company has any transactions, any outstanding balances with a struck off company, they need to be disclosed. So this is something that is again important. Disclosure of loans and advances to directors KMPs. So if somebody has any outstanding amounts, any loans or advances given to the directors in the company, that now needs a disclosure in this form. So again, something that somebody can try and use financial year 2021, so that the disclosure is not required to be given next year. Coming to the next part, next, this is something that will this will impact more with respect to financial year 21-22. So the stock statements, quarterly stock statements or statements of current assets, will be required to be the management will be required to confirm that the company's borrowings, the company's books of accounts show the stock and the assets equal to what has been disclosed to the bank on a quarterly basis. This is a very, very important change, and this is a very, very important liability. This liability has also been put on the auditor in the auditor's report for them to check. So it is the time where stock statements or statement of current assets were prepared without looking at the books of accounts is over. Now we are looking at an era where that will no longer be possible. Willful defaulter, again, if somebody has willful defaulter tag on them, they need to report it in their financial statements, and that is also something that needs to be taken care of in that sense. Change charges, current maturities, utilization. So if there are any charges which are pending to be made in the company's charges register, or charges which are not yet vacated or not yet satisfied, that needs to be reported. Current maturities of long-term borrowings, there is a change in classification on how these will be classified in the balance sheet, making it more clear and making these part of borrowings which were not earlier becoming part of borrowings. Now they become part of borrowings. There are details in respect of borrowed funds and utilization of borrowed funds and funds which have been loaned out. So this is also important, that the utilization needs to be disclosed, that the utilization is proper. Number of layers of the company. So there is a regulation in Companies Act which says that the number of layers cannot be more than two, cannot be so the third layer you can make a investment through third layer. A can own B can own C, but beyond C you cannot have an ownership. This is the structure that is there. Compliance with the approved scheme of amalgamation, in case there is an amalgamation scheme or a scheme under section 230 to 237, then that compliance with that scheme needs to be talked about in the balance sheet. Security deposits, finance lease liability, there is a change in the disclosure requirement, not something significant. Rounding off has been made compulsory now, so in case, and it has also been changed that it is not only on turnover but on total income. So wherever the total income is more than 100 crores, it needs to be in the nearest lakhs, millions, or crores, and wherever it is less than 100 crores, it is to the nearest hundreds, thousands, lakhs, or millions, or decimals thereof. This kind of a rounding off with respect to total income is now required. General amendments. So there's some renamings have been done, where how the non-current assets. So this is not something important. I think for the paucity of time, I will just skip this. Title deeds. There was a requirement earlier in the Caro report that title deeds, if they are not in the name of the company, then they need to be reported. Now that has also been brought into the financial statements itself. Disclosure on revaluation of assets. Now, Ind AS and other accounting standards now allow a company to revalue the assets extensively, and that revaluation is therefore now important for everyone to understand that where is the money, or where are the asset values coming from. In case and the company is now accountable to say whether these revaluations have been done based on the valuation statement given by the registered valuer or not. So that accountability has now been brought in. Benami property, any disclosure needs to be given, something that I think most people might have already dealt with. But if there is a property which is a Benami property owned by the company, where the funds have not been the company's to use, then that is something that is identified here. Undisclosed income, any undisclosed income that the company might have disclosed to the income tax department also needs a separate disclosure. CSR disclosure is also very important now. So CSR regulations also changed last year, so which will impact financial year 2021. But beyond that, CSR disclosure is also now compulsory. Last in the companies in the schedule 3 is cryptocurrency. Now cryptocurrency disclosure is also required, that what is the kind of dealing the company has had in cryptocurrencies. These are the changes in the audit report requirement. Dividend declared or paid compliance is now required to be stated specifically in the audit report. Then there are changes in CARO which will take place for financial 21-22, whereas where consolidated financial statements will now need CARO reporting for the subsidiaries to be made part of the CARO of the holding company. Similarly, there is title deed disclosure, current asset statement, stock statement disclosure, this which I discussed earlier. Disclosure of undisclosed income is something which is also part of CARO now, and default and repayment of a loan has been revamped. This disclosure was there earlier, but it has been revamped to allow for a more clear and more robust disclosure. These are some changes in the Caro report. Willful defaulter has been added. Use of short-term
See, your
loans for
voice is,
long-term
you're not
use has been
audible and
reintroduced.
the
This used to be
video
part
is
of
freezed.
Companies Act 1990 Companies Act 2013. End user funds, whether if there's diversion of end user funds, then that needs to be talked about. Fraud reporting, extension of fraud reporting is something that needs has been revamped. Managerial remuneration clause has been removed. Review of internal audit systems and reports is something that is there. Comments on cash losses, comments on issue objections and concerns of outgoing auditors, CSR compliances. These are all changes in Caro report which will influence next year. So the auditors will also perhaps try to make sure that next year there is no issue that they will need to report. And this year in financial year 2021 only, they will address whatever issues are pending in any financial statements. Changes in directors report. These are a few changes. So proceedings pending under IBC now are made part of the directors report disclosure. If the company has any pending IBC proceedings and NCLT, then they need to report it. This will be applicable for financial year 21-22. Difference in valuation at the time of OTS and then when taking the loan. You take a loan, you say my valuation of my assets is 100 crores. When you go for an OTS, you say no, they are no longer 100 crores, these are 50 crores. So now you have to disclose that what was the valuation when you took the loan, what was the valuation when you did an OTS. And then of course the CSR annexure in the director's report is also something that has been introduced. Reconciling books of accounts, ITR and Form 26A. So party-wise reconciliation of revenue in Form 26A versus the books of accounts is a must. Party-wise reconciliation of TDS, TCS, and identifying any unmatched, provisional, or overbooked TDS entries in the 26As is also very, very important. Reconciling IT refunds, IT demands, information on pending and completed proceedings will also be now there in 26As, and one can recognize that. Reconciling advanced taxes, self-assessment tax, something that was already there, but I think this just needed a reiteration. Reconciling SFT reports. So this, some of these have been visible last year also. So they will further perhaps have some enhancement where mutual fund purchases, property purchases, bonds, cash deposit, cash withdrawal, party-wise details are not available. But in totality, one is expected to reconcile these. Reconciling TDS in consideration for sale of immovable property, rent paid, TDS deducted, income where TDS was not deducted. All these are also important. Identifying TDS defaults appearing in Form 26AS and taking corrective action, and reconciling turnover as appearing in 26AS. So 26AS drags out now the turnover which is appearing in GSTR 3B, and one can reconcile that. I will now pass on the baton to Sandeep ji. Maybe he can take care of the reconciliations in the GST system and talk about how these impact the financial statements and why these reconciliations are important.
Good evening to all participants. Thank you, Ankit, for giving me this opportunity to talk about the GST reconciliation part. GST reconciliation over a period of time has become very, very critical, and as a result of this GST impact, we are supposed to handle it in a three-way reconciliation, which is the reconciliation with the books of accounts, as well as the returns which have been filed, and the two-way part. So there are situations where we are taking the input credits against the various purchases which we have made over a period of time, and the GST law does permit us to claim the inputs on a provisional basis. And whenever we take the inputs against the various purchases which we have made, we are supposed to consider them in our GST returns. However, it does happen that during the period of time, there are situations where these GST inputs which we have taken are not reflected in the returns, because in certain situations the vendors may not have been paid, or even certain situations the vendors may not have reflected those GST in their respective returns. As a result of the same, there is a situation which comes up whereby we are supposed to reverse those inputs which we have already claimed. So there can be two situations where inputs are not claimed for financial year 2021. We can still claim those inputs, and the last date for claiming it till end of September 2021. And wherever we have claimed the inputs which are not duly reflected in the GST portal, we are supposed to reverse it, and those reversals should be done within a period of 180 days. And whatever inputs we have claimed, it has to be reversed, and if there is any liability which comes, it has to be paid off. Now, similarly, there can be a situations where there are reconciliations which are pending, because it does happen when we do the three-way reconciliation that there are certain transactions which we have reflected in our purchases at the time of filing our GSTR returns, monthly returns. These may not have been reflected, or they may have been reflected, but the transactions have been carried out at a later date. So whatever there are any ineligible input credits which we have taken, we have to reconcile it, and we have to accordingly amend our returns, and suitably tax needs to be paid. Now, similarly, there is a 5% threshold which has been given for the input, and if it is more than the 5% threshold, then we are subject to payment of interest, and in certain cases there are penalty provisions are also there which we have to abide by. Then there are certain situations where GST is required to be paid on reverse charge method, and whenever there is a transaction with certain specified category of persons who are not supposed to discharge their GST liability on the output, the responsibility has been cast on the service recipient to pay those liabilities for the GST, and these GST liabilities are supposed to be discharged by the service recipient, and it has to be done in a time-bound manner which is specified in the law. And similarly, the inputs are also available for such payment which have been made. Can we go to the next slide, please?
Yeah, here you go.
Yeah. So now there is another important part which is there, that whenever we are doing the reconciliation, those reconciliations are important from the point of view of the inputs which we are taking, and similarly the turnover which has been reflected in our books of accounts as well as the GST returns are also supposed to be reconciled in a time bound manner, and whenever there are any pending transactions, those are required to be duly accounted for in the books of accounts. Similarly, there are cases where we are supposed to issue the credit notes, because it does happen that there is a transaction which has taken place with the customer, and later on we are supposed to issue the credit note. The credit note can be issued for various reasons, whereby the sales is returned, sales is reversed. So if there are any credit notes which are issued, those are required to be accounted for duly up to September 2021. And this is very critical, because in the case of credit notes, there will be a reverse impact on the GST part, and it should be duly reflected in the returns as well. Similarly, there are situations where there is a refund which is being claimed from the GST department. Those refunds can arise in various situations, and these refunds should be claimed whenever there is an export or there is any related aspects. Then those should also be checked from the portal as well as the GSTR return, and similarly the books of accounts should also be duly reconciled and checked for those refunds. Now, there is another reconciliation which is becoming very, very important, because a new law has come up by which there is an e-invoicing system which has been put into the place. Now, if there is a registered person who is having a turnover of more than 50 crores of rupees from the beginning of GST era, which is 2017 onward, in any of the preceding year, then he is supposed to issue the e-invoicing whenever there is a B2B supplies, which is more than 50 crores. Now, if the invoices are wrongly issued, then there is a penalty which is defined, or if invoices are not issued in the e-invoicing method, then again there is a penalty. And similarly, the recipient will also not be able to claim the input credit against the same. Now, this e-invoicing system gives another angle to the GST reconciliation, and like we were having books of accounts, we are having the returns, then now we are having a e-invoicing method. All invoices may not be issued through e-invoicing method, but there are certain invoices which are issued through e-invoicing, which are stipulated transactions. Now, there is another thing which is very, very critical from the reconciliation point of view, which is critical, and if there are any corrective actions which are required to be made, then suitable correction should be made in the books of accounts. And similarly, whenever there are any reconciliatory effects are required to be given in the returns, those are required to be given on immediate basis in the next return. And whenever we are filing the annual returns, in certain situations, there is no provision in the GST law for filing a revised return. So therefore, the reconciliatory effects are required to be given in the annual returns whenever we are filing the annual returns. Now, there is another situation. I think I'm exceeding the time. I will just try to close it early. Maybe another 2 minutes. There is another situation where we are issuing the e-way bills. Now those e-way bills are issued, and now there is another stream of information which is available, which is in the shape of e-way bill, and those e-way bill are to be reconciled with the invoicing which has been done, and similarly it has to be reflected in the returns, and it has to be reflected in the books of accounts as well. So there are few important aspects which are very, very critical, which I would like to reiterate to sum up. There is new changes which have been introduced effective January 2020 onwards, whereby the GST department and the tax officer can suspend the GST registration. This is very critical. Earlier this was not there. If there are discrepancies which have been found by him on comparing the details of outward supplies furnished in GSTR 1 vis-a-vis the GSTR 3B, and similarly on comparing the details of inward supplies reflected in GSTR 2B vis-a-vis the GSTR 3B. Now, importantly, we have just discussed the Form 26AS, which is the income tax information which is available. Now it has been showing the turnover which is reflected in the GSTR 3B. So they are interlinked with each other, and now the information is available in a transparent manner. Whatever information we are having in the GSTR in our GST rated database, the similar kind of information is also tagged and available with the income tax portal under Form 26AS. Yeah, I think I've discussed this. Can we go ahead, please? Yeah, can we go next slide? Yeah, so now we are very close to the end of the financial year, and income tax return filing is likely to start soon. And there are certain practical aspects which we are required to keep in our mind while attempting to prepare the information for our income tax return filing. Few of the information which are very, very critical are basically the exempt income. We are supposed to have the clear information about the exempt income which is not subject to tax. And importantly, the second aspect is to collect and get the information relating to the foreign bank accounts and foreign books of accounts and balance sheet for our subsidiaries, wholly owned subsidiaries, as well as the branch offices which we have in our overseas tax jurisdiction. This is very critical because whenever we are going to file our tax return and finalizing our balance sheet, in most of the situation, either they will be merged in our balance sheet and our income tax return, or in certain situation, tax benefit is also required to be taken for double taxation. If certain taxes have been paid in overseas tax jurisdiction, then those needs to be taken care in filing our consolidated tax return here. Choose the schemes wisely, whether we are going for old scheme or new scheme. We have to disclose the operative and non-operative incomes. Then the important task is the capital gains. Now, There are certain transactions which are subject to capital gain tax. Those are required to be checked very, very carefully, and the information has to be compiled and reconciled in a manner that it is captured in the returns precisely and properly, so that appropriate taxation liability has been taken care of at the time of filing the returns. Can you go to the next slide, please?
So one thing which is important is the new 10 crore limit for not no tax audit. So that's something that many people will have to get checked beforehand, because for them, without tax audit, the due date of filing is much before. So that was something that I wanted to bring to everyone's attention, and there might be a few individuals for whom that might be applicable.
Yes. Now we have to understand few more things. There are, like I have already discussed, that now information is available in a seamless manner amongst the various government portals. Information which is available for the customs and export data is also available. Then we have to go electronic, digitize everything, because now these days most of the things are being handled in a digitized manner, whether it is tax return, income tax returns, or GST returns, or maybe any other information for that matter. And importantly, like we have discussed earlier, the reconciliation with the income tax information which is available on the portal, which is 26 AS, should be simultaneously carried out with the books of accounts. There can be mismatches in various cases with respect to TDS and tax deposited, or maybe for any other matter which is duly reflected in 26 AS. If there are any reconciliatory effects which are coming up, those needs to be taken up with the respective person concerned, and rectification needs to be taken off on an immediate basis. Next part is we should on immediate basis start consulting our auditors, tax auditors or GST auditors, and our tax consultants to discuss about the various aspects. How should we go about the closing of our balance sheet this year, and simultaneously on the taxation part, tax returns, and of course the GST returns and the reconciliatory effect which has to come up in the books of accounts, and the balance sheet needs to be suitably taken care of. Yes, there are certain advantages which we have. We have seen in the last year that after filing the tax return, the government was very prompt in giving the refunds. And similarly, if we are able to file our tax return well within the time, and maybe even prior to the due date of filing of the returns, then if there are any tax dues which comes up, then we can very well save on the interest liabilities. And similarly, we can get our refund earlier than uh, filing it late. Yeah. Can
Also, the department, the government has taken a decision that this year the return revision date will be 31st December 2021. And we saw last year when we filed the returns of many people that the government processed the returns in due course of time, but they maybe processed these returns only a week before 31st March 2021. And that was especially for those returns which were filed around the last due date. And those people who got some kind of a rectification issue, some kind of a compliance requirement from the government, were not able to revise their returns because of that limitation of time. So therefore, it is encouraged that next year the revision time is even lesser. So filing the returns earlier will always help in revising the returns earlier in case there is some error that crops up in the records of the department.
Yeah,
So
can we go to
I will now quickly go through the
yeah.
this list of due dates or the relevant dates that are important for us and why are they important. So TDS payments for March 2021 are required to be made before 30th April. So that kind of means that you have to look at all the expenses that you have for financial year 2021 and make sure that all those expenses have been TDS has been deducted. This is in a way a last opportunity after which interest will be payable on any TDS that is deducted nevertheless. So this is something that is a very, very important date. MSME 1, again, you need to recognize which MSMEs are outstanding as on 31st March 2021 and talk about those and report those in this MSME 1. Again, the due date is very, very close. It's 30th April. TCS return then needs to be filed on 15th May, something where, yes, you again need to close the books of accounts and talk about whatever wherever TCS is applicable, that needs to be closed. LLP or changes in shareholding or changes in partners needs to be closed by 30th May 2021. You cannot extend beyond that. TDS return needs to be filed before 31st May 21. Then there is SFT return that needs to be filed before 31st May. Why I am also talking about these return filings for TDS, TCS, and SFT is that you also understand that if they are filed by people by 31st May, then you will get the processed result in your 26 years most probably by maybe in 1 week to 15 days from 31st March for 31st March 31st May. In case you don't see the credit appearing in your 26 years on maybe 7th June or 15th June from somebody who you were expecting TDS credit from, then the time to start following up is that time. So on form because legally every person who has deducted TDS on the amounts that they have paid to you. The due date is 15th June 2021 for them to share Form 16 and Form 16A. In case somebody does not share these by that time, then these can always be followed up. Sorry. So advanced tax due date, why is it important? There are several people who do their advanced tax calculations specifically for June quarter and for September quarter based on the tax that they have paid last year. So in case your tax for the last year is not final by that date, then you will again be filing some advanced tax which may not be accurately computed. DPT3, again, something which has a bearing on the books of accounts. In case your books of accounts have certain deposits outstanding, then that is supposed to be reported in the return of deposits. Annual return to RBI also needs a lot of disclosure, which require your financial statements to be closed. Annual income tax return for non-audit cases, again, any planning for remuneration to the salaried partners, to the salaries, to the remuneration that you're giving to other people, any changes there can happen only before this. This is also the due date when after which all individuals should be filing their returns, including the directors who are not partners or who don't have any other business which is subject to tax audit. So these are important dates. Then of course we have September, October, November, December, when we have the usual due dates, which I think most of you must be already aware of. But the idea is to file early, not wait for the due dates. In case you target that you will like to file by July, maybe your corporate return or your corporate filings or your corporate financial statements, you want to finalize them by July. Maybe in that case, everyone will cooperate and spend more time in making sure that you are not troubled by future litigations, future reopenings. The idea is very clear that the government now has made it very, very clear that they know everything about you. They have linked GST portal, income tax portal. They have even linked the tags, the taglines or IFAs, the system that they use to collect tolls is also now integrated with the e-way bill system. So everything is now transparent. In case you have a substantial size business, then you have to do everything right on the go. There is no option that at the end of the year, some magical professional will come and resolve everything for you. Quarterly reconciliation of TDS is very, very important. So the idea is that people come to me and say that, okay, how can we finalize this at the end of the month? How can you expect that we will finalize everything by the end of the month? So there are companies like Infosys which have such a big turnover, such a big workforce. They are finalizing their financial statement within days of the end of the financial year. So it is possible. The key is to do things on the go. So every 15, in case you say that, okay, my accountant will come at the end of the month and complete the accounts for March, you need to retro think again and see in case the accountant can come and complete your accounts in 15 days on a regular basis based on the size of your business, based on the size of your operations. Maybe Anil sir will like to add something further before we wind up. Sandeep ji can add something more that I might have missed.
Thank you, Ankit. The very important part that I would like to say before we conclude, that before even we start preparing any financial statements for any client, we should actually inform our client that what they know. What they know is very important for the client to know. Before he prepares his financial statement, the government departments know much more than even at times you know yourself. So there are many things that we actually can know about ourselves from various government portals and publications, starting with the e-invoicing or e-way bills, e-invoicing when it starts, but the e-way bills are presently available, which you need to verify before even you file and the GST returns. This AS26 is, of course, is a complete chitta of your activities. It also includes statement of financial transactions, the whatever income that you have earned, the TDS returns, then coming to the GST portal that we have most of the information on the GST portal. Then the this financial intelligence unit also records suspicious financial transactions. The credit information companies, there are 5 credit information companies authorized by RBI. They collect information about your the debt and your credit records that actually may give you the information about your defaults in the various loans and credit cards. Information utilities is a new concept introduced along with the IBC that also may have a lot of information about the transactions, about the debt, about the receivables. CERSEI, the central registry for various mortgages, CERSEI would have information about all the mortgages that is created in the records of CERSEI on the assets owned by the company. The ROC records shows that various charges, whatever has been created, that also has to be reported. These are all various things that we must tell our client that this is what they know. And based on all this, the financial statement has to be concluded. If anything which is mismatched, a reconciliation is required to be made. And if anything which is not reconcilable, then of course the all kind of precautionary actions has to be taken. So this is a Ankit and Sandeep, this wonderful idea to come up with such kind of webinars, which gives a kind of alert to our client, to public at large, to other professionals, that these are the requirements of the time now, and we are supposed to be prepared well in advance. I think Ankit, you very well said that we should not wait for the last day, and we should prepare ourselves very well, because in case any reconciliation is required, that should be done much before the last date for filing of returns. This again is a series, we would call it as my way of learning. Similarly, Ankit and Sandeep also would call it as my way of learning, because this is genuinely uh, our way of learning. Individually, we all call it as my way of learning series. Thank you, participants, and thank you, panelists.
Yeah.
It
Thank
is
you.
wonderful, and
Thank
we
you.
definitely
Thank you to
enjoy when
thank
you are connected with us.
you also who have contributed in this presentation and shared all that they have learned over the job. So thank you everyone. Thank you
Thank
all.
you. Thank you.
Thank you.
Thank you. Thank you.